Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Tuesday, June 18th, 2019. It's 1:48 p.m., so we have just over 24 hours until the FOMC rate announcement. And in this video, I want to do things a little bit different. Since I don't expect the markets to do much from where they're at right now until tomorrow, we will get to the short-term charts. There was a little lift in the futures, news-driven by two different headlines. One coming out of a tweet from Trump. As usual, trade talks are going well again, and nothing, of course, nothing specific there. And then we also had Mario Draghi come out and talk about, looking to maybe cut rates again, ECB cutting rates and or extending their bond program, which is already massive. So both of those two together, lifted futures. But again, we'll probably continue to, what I said this morning and put out a post on the front page, and we're up about I think it was 1.13, 1.15% on SPY, and I said that's probably about the highs for the day. We'll probably fade off that, and so far that's been the case. But again, let's focus on the long-term charts right now, because every now and then I have to step back out to those. The long-term charts, in very large part, formulate my shorter-term and intermediate-term bias on the markets, primarily the intermediate-term outlook. Short-term charts are dictated by 60-minute charts, daily charts, but even then, there are certain considerations to make based on the long-term outlook. So we're going to start here. We'll keep it very simple. We'll just look at price, and then I'll add in the indicators down below. But this gives us a clean chart here. This is a multi-decade chart. This chart spans almost 3 decades back into the late 80s. So you have almost 3 decades of price history here, or over 3 decades, and you can see every bull and bear market that we've had. Starting with this one here, that bear market right there was followed by the strongest bull market in history up to that point, only rivaled by this one now, which is roughly equal in both scope and duration. So we're about to, I forget exactly where that point is, at some point this year, sometime soon. Either way, you can see that's just one heck of a run up, similar to the one that we've had now. Now, what do they all have in common? Well, they've all ended with, and I'll have to put the indicators up in a minute, but they all, what they have in common, they ended with divergent highs, negative divergence on the in this monthly time frame here. And so we had a divergent high, and that last high that we had in 2018 in SPY, or the S&P 500, which then went on to put in effectively an equal high. We came up, and again, it was mere basis points. We didn't even take the high out by a full percentage point. I don't even think it was a half percentage point. I think about 0.2%. So roughly an equal high, but that's all you need to put in and extend divergence, as long as the indicators are moving lower. Again, we'll get to the divergences in a second, but I wanted to mention that with few exceptions, or zero exceptions so far, that's where the big drops came from. This one right here technically wasn't a bear market, at least not in the S&P 500. It was, you did exceed the 20% threshold drop in the small caps, mid caps. I believe the NASDAQ composite, or the NASDAQ, came very close, about 19%. And either way, some have considered that a bear market. I think, who was it, Warren Buffett, that said, if it's not a bull market, then what is it? And so what happened is we traded for almost 2 years, well over a year and a half, down to sideways, where it took about that long to take out the previous highs. You can see the scaling down here. And so again, these are just the rough drops measured from highs to lows. And what I wanted to point out are a few other things here. Now you'll notice a blue dotted line. That is up top here. You can see the 20-month exponential moving average, and it's just done a bang-up job. If you want just a super simple long-term indicator to try to gauge whether we're in a bull or bear market. Again, the beauty of this, first and foremost, is simplicity. It's not a several moving averages together. It's not a complex formula, and it's simple. When the stock market is trading above the 20-month moving average, the trend is bullish. You're in a bull market, and when it's below, the trend is bearish. Now, very important, and I'll say this repeatedly: anytime you're trading on a particular time frame, in this case a monthly chart, all that matters are your monthly candlestick closes. So it's quite common to see intra-month to see a break of a support level or a trend line, or in this case that 20-month EMA. Now here it broke and it went below and it stayed below for several months, about 4 months below. That was a small, relatively quick bear market. Or 20% drop, call it whatever you want, and then we got back above it. But you can see it has just done a bang up job. And when you do see candles below, they're usually intra-month pierces that closed right back on or above the 20-month. Now there are a few whipsaw signals from time to time. Nothing's perfect, I will say that. But again, if you just replicate this on your own chart, you'll see it has just done, again, these were intra-month pierces, but we came back and recovered. We hit that 20-month, closed above it and stayed above it, and it was only until this point right here, you see the first red candle that closed back here. This was the dot-com bubble back here, the 2000 market top. Remember, our scaling, or the years, are down here. So you had a solid red candle down below, traded the next month, stayed below, tried to test it from below twice, 2 candles that failed right on it, and that kept you intact. So you had a sell signal there by that one metric. And as is the case when you're trading, let's say, a trend line or a support level, a price support level, support once broken then becomes resistance. So it's 2 takeaways. If you're bullish and wanting to get out of your stocks, or you want to know if when the bear market's over, well, you'll know when that line has been recovered. And if you're bearish and you like to short, bounce backs to that 20-month EMA proved to be good shorting op, especially early on. And then, of course, you can see we regained it back here in 2003 after the market bottom, shortly after, and it just, again, did a phenomenal job of defining the uptrend until this is our last bear market here, which most of you, if you don't remember that one, you probably remember this one, unless you're really young. All right, so we had a big solid red candle that went down and closed below right there, and that was a beautiful sell signal because it came in conjunction with the break of the primary bull market uptrend line as well. So there were 2 sell signals in once that month. You had a monthly close below, and you took out the 20-month. You can see that next few candles went down below, and that confirmed that sell signal, walked away, clearly away from the trend line, clearly away from the 20-month, and then you had a gift. If you were long and you were trapped, or you were bearish and you missed that entry, boom, your gift was that kickback to the 20-month, where we had 1, 2, 3 failed candles, finally a rejection, 3 months of failing there, and then boom, the bottom fell out. So usually it's that first initial bear market rally. That's your last chance to get out of Dodge if you didn't do so earlier, and then usually you get the impulsive selling after that. All right, so from there, what happened? 2009, we know the market bottom. We regained the 20-month here. Again, like I said, there's been some more whipsaws in this bull market, this supersized volatile bull market. But a lot of these candles closed on or above there, or had a 1-month candlestick, little whipsaw below. But again, if you're trying to score it, nothing gets 100% in trading. There's no one indicator that works perfectly, but this one's done a pretty good job since. And then we got sucked into this. Some consider that a bear market. It was sideways again, 2 years of roughly sideways trading, and about a 15% drop in the S&P, where most other indexes dropped below, hit 20% or below, like the small caps, mid caps, a lot of sectors. And then boom, once we regained it, we've stayed above it. So let's zoom into what's happened recently. Well, we had a candlestick right here. We had a monthly close below, and then we regained it, and we're above it now. So here's what I'm watching. This is all leading up to where we're at now. We've had, first of all, the primary bull market uptrend line, this yellow trend line. Right now I have it drawn off the bottom of that candle, the last monthly candle in the bear market. That would have been March's candle. We bottomed in March 2009. You can draw to the bottom. Trend line drawing, as I often say, is an art, not a science. So you can pull it down there, and if so, you still have the same story. You have a very impulsive breakdown of the primary bull market uptrend line, a back test, and a rejection last month with a bearish engulfing candle to boot. So we had impulsive rejection. So I'm going to just put that back to where it is. It really doesn't change where the trend line comes in here. And I also have this alternative trend line. I think it's a very important trend line off the early 2016 lows. That one was broken as well. So by that account, we had sell signals in 2018. And remember, the majority of stock indexes out there are still below their 2018 highs. And that's why one can argue whether we're in a bear market or not right now. We certainly hit the threshold with the S&P dropping just over 20%, NASDAQ well over 20%. Every index dropped 20% or more. But the SPY came back, made a roughly an equal high to the previous high. I think it was 0.2% above there to be exact on the S&P 500. So that's basically a double top, and it just simply extended that divergence. And so that's where we're at now. We're kind of pinched, I think, in a very important technical posture. We're right above that 20-month EMA, but we're below the primary bull market uptrend line. If I had to put a higher weighting into one of the two, it would certainly be the trend line. I put a higher weighting in there, especially since we've had a lot of whipsaw signals in this 20-month EMA. It's not, during this bull market, it didn't work as good as it did in the previous bull markets. But it's worth watching still. Doesn't mean it's not effective anymore. It just means we've had a lot of volatility here. And again, if you got out when it pierced below there or closed below right there, you avoided, you got out that month. Using that signal alone, you sidestepped another 6% drop that went on for 1, 2, 3, 4, 5 more months. So it's not as if that was a false signal. It just didn't prove to be anything more than that. So to keep it very simple, mixed bag of technicals, but what would chip away at the bearish case but not completely negate it? Well, that would be a move back over in a close. Again, all that matters is how we close this month, and I'm doing this video now because we have the big FOMC meeting tomorrow, and that's probably going to very likely be the tipping point as to whether we reverse and then print a keep below yet last month's red candle, especially if we have a very sharp sell-off this month. If we could turn this green candle into a red candle now, I would say get out of Dodge with both fists. That would be a extremely bearish technical event to see. We've had some nice gains this month so far. To see all those gains wiped out in the next, what do we have, less than 2 weeks to go now before the end of the month, that would be quite bearish. So if you get a red candle, especially closed below last month's bearish engulfing candle, quite bearish. Now if you close above it, that is certainly not bearish. It would be bullish because it would negate the whole, the sell signal that we got with the monthly close, the monthly bearish engulfing candle last month. And again, it wasn't just SPY, it was just about all indexes put in a bearish engulfing candle. We also had one back here that engulfed several months of candles as well. So far, again, you have dual bearish engulfing candles right at the same level. And to take it out would not only just undo those bearish engulfing candles by moving back above them, but it would also pop the S&P to new highs again. So there's that, and that would then diminish the chances but not negate it. And I want to make this very clear, and I have before. Moving above the recent highs in the S&P 500 is not an all or none where everything, the technicals suddenly flip from longer term bearish to bullish. Why? Well, because number one, you're still below the trend line. Sometimes you come in and backtest the trend line after a breakdown. Again, pulse of breakdown helps to verify it, validate it, I should say. Sometimes you come in and backtest one and done, and then you move lower, and that's that. Sometimes you backtest for several months. Sometimes you backtest and then regain a trend line as well. But we could certainly, and you can see here, there's plenty of room to come in for another backtest of that trend line. And there's also room to extend the divergences. So now let's talk about divergences and put these indicators up here for you. There's the PPO, the RSI, the rate of change 12. I like to use these on monthly charts. All right, we'll start here with the PPO. PPO, there are a couple ways, several ways to use the PPO. The most simple is traders will look for bullish and bearish crossovers. That's when the lines cross. We'd probably, here, I'll park these for you so we can work just on the PPO right now. Let's park the RSI, and let's make the PPO a little bigger so you can see. All right, so there's your crossovers. As you can see, the fast line crosses down below the signal line. This is your PPO line, or the fast line. It moves quicker, and then you have a 9 EMA, which we call the signal line. And so that in itself, right there, for example, here was our last bear market. What did you have besides the divergent high? besides the breakdown above the bull market uptrend line, besides the 20-day EMA getting taken out on a monthly closing basis, you had, yep, you got it, a bearish crossover. So that's pretty simple and also very effective on this monthly time frame. Try to use this on a 60-minute chart. It'll work for short-term trades, but it'll also get you whipsawed a lot. You can see here very few false sell signals, and as I noted here, so when the PPO line is above the zero line, the trend is bullish, and when it's below, bearish. Let's look at that. So we had a bullish cross right here. Let's see, well, we were bearish from here. We were below from this point to that point. Not the most effective, and I also say this as well. I wanted to cover that period because I say when you have compressed volatility and you do not have clean separation between the lines, stay away from it. Stay away from trying to extract any useful information from the PPO. What you want is clear separation. You can also put up a histogram on the PPO and you'll see the histogram bars higher. It's when you're in a choppy or a very tight, even if it's a trending market, whether it's sideways or trending up or down, if there's not a lot of price volatility and the candles are real small, you're going to get some whipsaws. But from this point here, you can see we had a pretty clean signal, a lot of separation, and that line often comes in and acts as support when back tested. So it said bullish from that point there, right here, up to this point. You had a bearish crossover right there. Proved to be a whipsaw signal. We crossed back above, but then we crossed bearish again, and that did mark the top. And from this point right here, which was about right somewhere right around the time we broke down there, you can see all the way to here, it was the lines were crossed. You can see, in other words, the PPO line was down below the signal line. Likewise, we got a bullish cross right here, right around the time the bear market ended back in 2002, and it said stay long. It tried to give you, they tested a couple times. Sometimes these lines kiss, but it stayed above and said until this point that the trend was bullish. So you can see a pretty darn good job. There's a low of the 2008 bear market. This isn't going to get you in and out at the top and bottom because it's a monthly chart. These signals will come late, just as the monthly candles. You have to wait for the monthly candles to finalize. But again, with a few whipsaws, other than that, you can see it's just done a great job of defining the trend. Where am I going with that? Well, fast forward. Besides just, the takeaway from that is we had a bearish cross here when I and others believe that, the U.S. markets as a whole, not just any one index, but as a whole, entered a bear market. You had a bearish crossover. You also, back then, just like what was that, 2008 that I was covering, you had a little whipsaw signal where we popped back above, but again, they crossed back below and they remain below. So right now, at least this one indicator remains clearly on a sell signal at this point in time. So what I'm doing is just giving you, one by one, the bullish and the bearish. All right, so that's that. And then the other thing, and I've covered this many times, it's a very simple, also yet effective indicator. It's to look at the posture of the PP. The signal line again being the 9 EMA. And it's just simple. When the 9 EMA, or the white line here, is above the zero line, like it was here, the trend is bullish. Or at least it's indicating the primary trend is bullish. And it's not going to get you in at the top, or out at the top and in at the bottom, but it will keep you in through the bulk of the run. From here to here, as you can see, said the trend was bearish, and it captured the bulk of, not all, but the bulk of the bear market. Again, it didn't get you out right at the bottom, but that's a trend indicator. So you can see it there. There's most of the bull market from 2002 up to 2007. There's most of the Great Recession or the bear market there. Here, what I'll do is I'll even come in with the box. Let's move it all the way up top to show you this, where we'll take these lines. So from there to there, right there, that's about horizontal. So it got you in about halfway right before the bottom fell out, and then we had the big meltdown. So again, just a trend indicator to watch. Now, it's far from signaling that we're in a bear market. And remember, by the time it does, let me show you again. Let me try to zero in. I'll use the crosshairs. Yeah, it was about halfway through. It was much too late to get out or to get short at that point, but it does help you to look at the primary trend. I like these crossovers better on the PPO line, being above or below, but this is just a different way to confirm, especially if we enter a much more prolonged bear market, which I and some other people think that we're looking at, more of a Japan 1990s into 2000 type scenario where we're looking at a not just a 1.5, 2 year bear market, but something that's probably going to last for many years. Okay, and then just those other indicators again that will point out the divergences on with between price and these indicators. And again, you want them at least on one, if not more, indicators. And the more you have, the better. So that's it. So we've had again, we're spanning 3 decades here, and we've had 1, 2, 3, 4. This is just an extension. DH1, DH2 means divergent high 1, 2. The divergences are persisting. So playing the probabilities and the odds, that's what technical analysis is all about. That says the divergent highs are not sell signals in themselves. They're just merely an indication that a pending trend change is likely. And then the sell signals come on things such as trendline breaks and or backtests and breaks of key moving averages such as that 20-day moving average. Here's QQQ, a monthly chart, same time period. I won't spend as much time on it because I went through everything. But there it is, same stuff. We're watching the uptrend line. This is pretty well-defined uptrend line off the Qs of all. Remember, the QQQ or the NASDAQ 100 is not a very diversified, well-balanced index. It lacks a lot of important sectors in the economy. It's pretty much a tech fund. Or a tech index. It's very tech-heavy. Over half of the stocks in there are tech stocks, and then again, it lacks a lot of other blue chips in certain sectors. But it's a very tradable index, and it also is most concentrated, highly concentrated in the same market-leading stocks that are in the S&P 500 and many of the stocks in the Dow. So it's worth watching because where those market leaders go, that's where QQQ goes. And you can see just a very well-defined bull market uptrend line goes all the way back when QQQ bottomed in November of 2008, long before every other index and sector, or majority of sectors, all other indexes, which bottom in March of 2000. But we come in and we capture that candle. We hit the bottom. We capture all these pullbacks, all these candlesticks here, these little candlestick wicks, or shadows, I should say, the tails, the bottom part. And then we come in here. So we had a little bit of a whipsaw here. Broke it intra-month, but then regained it right there, and we're still flirting on that trend line. Back then, we did not have a divergent high. Actually, we had it on the RSI and the ROC12. But with the newer high, remember the NASDAQ was the only index that clearly broke out the new all-time highs. And again, not as diversified as the other ones. And that high failed so far. So what we're watching, same thing. We had a big bearish engulfing monthly candlestick last month on QQQ. We're going to watch to see if that how we finish the month, and then we're going to watch this 20-month EMA, which is below. Again, done a bang-up job here, probably even better than the S&P 500. Here's our bull market beginning right here, March of 09, or you can call it again on QQQ back there, roughly double bottom. And then look at that, boom, 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 1, 2, 3. What is that? 5 candles in a row. And remember, don't look at the skinny part. Look at the body and or look at the number of reactions. Whether you see the skinny part, which is a shadow, or the body, 1, 2, 3, 4, 5, just multiple reactions there. And it's just done a great job. So if it goes, if the 20-month goes, this trend line will go as well. So those are the things we're watching, and that will give us a pretty good sell signal, long-term sell signal, and tell us that we're probably in a early stages of a new bear market. Trend indicators, PPO line is still below the signal line right here. You can see it cross back there when we had that first drop, and it remains below. Again, that's a bearish trend indicator, if you will, just like it was bullish from here to here. And most of the time, we had some whipsaws here where it flattened out. Stay away from that. You want to look at these clean separations in the lines right here. Okay, and let's just skip the daily charts and zoom right on down to the 60-minute charts and stuff. And I'll just make it very quick. Today's pop, again, it was first future started lifting overnight with Mario Draghi talking about another rate cut and or also expanding their huge bond buying program for the ECB. That started the futures up, all U.S. and all, just about all stock index futures, and then it was followed up with a 1-2 punch from Trump. One of his usual give no details treat, just, oh, trade talks are going well, and obviously the market will hang on every little word. So those were certainly news-induced events, and take it for what it's worth. That's one thing. As I said, other than, if we didn't have any market, big headlines, we would have probably continued more of this until tomorrow. But we did. We had some big, not just one, but two big headlines, pop futures, and then that brings into play my alternative scenario, which was come up here, pop this level, put in a marginal new high on both SPY and QQQ, and that marginal new high would be a divergent high. So from here, very short term, forget about those monthly charts for a second, because we're not going to know until the end of June here how those charts finish. So for going for the next few days, especially after tomorrow, here's what we want to watch. What happens here? Will they, after the Fed meeting, if we have a pop, is it a brief pop? There's certainly room for that to extend the divergences a little more. And then that pop gets faded with these divergences then being confirmed. What do I mean by confirmed? I want to see a bearish crossover in the PPO on the 60-minute here. That will effectively put in a lower high. Because until we get that lower high by a bearish crossover, the PPO is a momentum indicator. If it's moving up, it can continue to move up, and then it would take out these divergences, and that would certainly chip away at my near-term and intermediate-term bearish case. Probably open the door up for a move to new highs there in the market. So that's what I'm watching for the next few days. Same story on QQQ. These were the lines I drew this morning, and I said at that point, probably seen the highs for the day. That's my guess, and it still is. And it was. They've faded the rally so far, and we're still positive. Right now the SPY is up. It was just on at 1.12%, and QQQ is up a pretty comfortable 1.68. But as you can see here, clearly puts in some divergences. PPO is starting to roll over. So again, I think we've already got the news. I can't imagine any more headlines as if those two probably weren't coordinated as it was. But that's probably what we'll do until tomorrow. And who knows? Maybe there'll be some profit taking or buying before. I don't know what happens in the next 24 hours. But I suspect it will remain below that 188.37 resistance level and probably above the bottom of today's gap. And then the fireworks start after tomorrow. So we'll just pick it up from there. And if they take out these divergences, and if they pop the highs and we keep going, I'll certainly do an update no matter what happens. But I just want to be clear, I still favor that scenario. And why? Again, a lot has to do with everything I just talked about on those long-term charts. There's still some work to be done, but to me they are clearly indicating a major trend reversal, a major top in the markets. And whether it comes tomorrow or next month or 3, 4, 5 months from now, it seems to me that there's a very, very high probability that's already priced into the charts, and any upside, even if the markets pop to new highs, is probably limited because there'll still be divergent highs, just as the previous highs were divergent highs in the market, and then they were followed by a substantial correction. All right, we'll wrap it up here and pick it up. May or may not do an end-of-day market wrap. I may just put this one out, and that's what I'll probably do because I don't expect anything big changing. If anything major happens before the close, I will follow up with another video at the end of the day. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.